From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, the first Real Yield show of 2025. We're going to take you through the year in fixed income. We're going to be watching geopolitics, the Fed, and the economy, along with everything that plays into the bond market. And of course, we'll focus on credit as issuance surges and private credit is poised for some more gains. We're going to begin, though, with the big issue, big questions looming on policy and the macro backdrop.
Volatility is going to be a little bit higher in the rates market this year, simply because the Fed is so data dependent and there's still so much we don't know.
On the fixed income side, though, and I know we've talked about this a lot in the last 6 to 9 months, we still see a lot of challenges.
We've come into this year with no bond bulls. I mean, if you find one, I would love to hear.
Markets think the Fed has probably already done too much, and the Fed's coming around to that view as well.
What do yields reflect? They reflect fear over inflation.
We're most worried about higher yields at the really long end.
The key driver of corrections has been higher yields in the back end of the curve, right? So that's clearly a risk.
There's a lot that can cause volatility, and that's what we think we're going to see for the first quarter of this year.
I want to take a look here first at the 10-year yield since Election Day, continuing to churn higher. You've seen it really trough and a bid come back into the bond market in late November, but really by December, you saw a lot of that wiped away. And the 10-year hitting 4.6% above that level, really, and then coming back down to just above 4.5%, really testing 4.6 once again. Let's flip up the board here, though, as well, and take a look at the 2-10 spread, sitting at the highest levels in over 2 years, because you do see that decoupling with the 10-year and the 2-year. Of course, a lot of that 10-year move has to do with fiscal concerns, as well as the term premium demanded more of investors here for the risk they're taking on in the longer end. But you do see the Fed's interest rate cutting strategy not really hit the mark when it comes to those longer term expectations because of it. Speaking of those rising yields, Earl Davis of BMO says the uncertainty over tariffs brings an opportunity to investors to add duration.
We actually tell people tariffs right now is providing us with an opportunity to go longer fixed income. And the reason why that is all the talk about tariffs and the unknowns have increased yields to these levels to what we would deem relatively attractive levels, both on a treasury and a corporate space. So we've been using this as an opportunity to add to duration and add to credit.
And joining us now, Al-Hussainy of Columbia Threadneedle and Leslie Falconio of UBS. And you take a look at some of the dynamics in the bond market, that volatility still under the surface. What's the biggest thing you're looking for, Ed, as you start the year?
Absolutely. I mean, it's the policy mix. I think the biggest source of uncertainty this year is most definitely the policy mix coming in, whether it's on the trade front, immigration, obviously fiscal policy, probably towards the end of the year. But underlying all of that, I think the change in Fed strategy that we saw at the end of last year and how that's going to play out is top of mind for me.
Well, it's interesting. You brought up the 2 points, of course, the fiscal and the monetary. And Leslie, which force is stronger here heading into this year for the bond market?
Well, I mean, listen, on the monetary side, the market is completely recalibrated, right? I mean, now they're looking for only about 38 basis points of cuts in 2025. And, we also believe there's only going to be about 2 cuts, one in June and one in September. So we're going through a very long pause there. But I do think, listen, monetary policy is still going to play an important role just simply because they're data dependent. And while the market's pricing in this forward-looking, potential policy implementations, you really don't know the impact of that until further out the year. I do think that both are going to be equally important. Obviously, the Fed's going to react to some of this policy implementation, but that data goes for a long time at the end of the year. Now everyone's focused on really what the Fed's going to do over the next 6 to 8 months.
Now, if you think about the Fed's moves and where it could really hit policy implications in the near term, Ed, you have an issue now where you have Janet Yellen writing to Congress saying that the new debt limit might be hit right around the time of inauguration. You have a speaker vote happening as we sit here right now. How do you really parse through those critical moments when policy can start to upend the bond market a bit?
Yeah, absolutely. So with respect to the debt ceiling in particular, the Treasury buys itself a little bit of time through these extraordinary cash management operations. So I think they still have perhaps well into the second quarter to manage that. Where it's going to impact us on the rate side is with respect to the Fed's balance sheet. We're going to start to see some tensions in terms of excess liquidity sloshing out there, the lack of T-bill supply starting to impact the very front end of the curve. But when I think about further out on the curve, I think the good news, at least for now, is we're going to have to wait for the big ticket items, most importantly tariffs and fiscal policy next year.
Well, it's interesting. So many people, when they think about the Federal Reserve, they think about that first and foremost function, the control of those shorter-term interest rates. But Leslie, Ed brings up an important point here about tightening, because you still have a massive amount of money on the Fed's balance sheet, and you also have the U.S. banking system's reserves shrinking. It tumbled below $3 trillion to the lowest since October of 2020. This is a critical story. A lot of people are keeping an eye on it in the market today. How do you see that impacting the dynamics for tightening for the Fed?
Well, look, I mean, the reserves are shrinking, but as Logan has pointed out, as Williams have pointed out, we still have ample reserves. But I mean, we do believe that more than likely the Fed will sort of wind down their quantitative tightening in the first or second quarter. So I do think there's, going to be plenty of liquidity in the system, but I do think they're keeping it a watchful eye in terms of RRP and everything that goes through the Fed's balance sheet. But we are expecting them to really start to, if not completely cease quantitative tightening, really start to slow it down at this first quarter and probably end by the second quarter.
So I want to go back to something Earl Davis had said a little earlier at BMO, this idea that duration is something that investors should consider taking on. Leslie, would you take on duration given all those risks that are still out there? And if so, how aggressively?
We are taking on duration, actually, but we're taking it around that 5-year area of the yield curve. And I think that what we've seen for us, I mean, we would extend further out that back end because we have not liked the back end of the yield curve for quite some time. And maybe if we got to that 2024 high of 475, then we would consider extending out further. But we have added on some interest rate risk here. And I think it's important to note that it's not just about the fact that interest rates have gone higher. It's the velocity, how quickly they've moved, right? You've seen from the September to the December Fed meeting, you've seen from third and fourth quarter about an 85 basis point rise in 10-year yields, not even mentioning what's happened to real yields. So we are adding on interest rate risk. We're keeping it a little bit in the short end right now, but we're looking for opportunities to add further out the curve, but we're just going to sit tight for a while until we get to around at 475.
If you have investors starting to take out duration here, you do see the potential for yields to start to moderate. Ed, would you take on risk? Would you take on duration risk at the longer end, 10 or even longer than that? And where does the 10-year start to head into this year?
Yeah, I mean, I would agree with Leslie, and I would say just there are two sort of relative valuation points. One is relative to cash. Again, the curve is steepening out. The prospects for maintaining those 4+% returns in cash are dwindling, and so stepping out onto the curve is becoming more attractive. The second is risk assets. So when you're looking at credit spreads that are at multi-decade tights, you're looking at valuation in equities. Who knows how to do that, but duration becomes a much more attractive buffer against risk assets. Now, where will the 10-year end? Going out into the very long end of the curve, you're starting to deal with fiscal risk. I think it's still quite scary when we're talking about the 10 to 30-year part of the curve. But when I take a step back, I would say at the moment, the curve is pricing rates to settle at right around that 4% level in the medium to long run. From my perspective, I think that's still quite high, given the risks to the labor market in particular, and given the success we've had in terms of bringing inflation down.
So what does that mean in terms of where you see the 10-year headed?
I would say sub 4%. So I would think sort of the 3.5% to 4% area would be my bet.
Leslie, what's your call?
We have, for 2025 at around 4%. I mean, we're assuming that the terminal rate, we don't think the terminal rate is going to end up at 4%, but so we assume a little bit lower terminal rate. We're going to add a little term premium onto that, so probably around that 4% level in 2025.
Spread makes a market. Ed Al-Hussainy of the Columbia Threadneedle and Leslie Falconio of UBS to start the year for real yield. And up next, we're going to talk about the auction block because there's a potential record-setting January underway for high-grade bond sales. Stick with us. We'll talk about it next. This is Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where we're going to look at global bond issuance. We start in Europe, where the EU lead market-wide volume for 2024 reached a record-setting 1.7 trillion euros. Sovereign issuers took the first 9 spots in the top 10 list of borrowers, with the 10th place going to TD Bank. Here in the U.S., borrowers wasted no time with raising money in 2025. High-grade sales on Thursday were $15 billion, led by Credit Agricole, Ford, and GM. And that action kicks off what some analysts say could be a record-setting January. An informal survey of debt underwriters called for $175 billion to $200 billion worth of sales, and that could surpass the record we saw just last January. And speaking of credit, Joanne Bianco of Bond Block sees major opportunities this year.
There's still a lot of areas of fixed income that you can take advantage of in the strong economy. And the number one area in our view is credit. We're just in a better quality environment, is particularly in the U.S. high yield market. There's more double Bs than there's ever been. The triple B corporate market is very healthy as well. So investors can take advantage of that.
We're going to get real deep into the credit markets now. We are joined by Akila, Grewal, Global Head of Credit Product at Apollo, and Sinjin, Bowron, a Portfolio Manager at Beach Point Capital Management. Both of you know how to manage risk. And when you have a higher for longer environment, Akila, you're looking at, from the beginning of December to the end of December, a drastic change in expectations already for rate cuts heading into 2025. Less than 2 really expected this year alone, and not 1 expected till later in the year. In a higher for longer environment, what does that mean for borrowers? You have to start to recalibrate how much debt they could take on, given that you have rates elevated.
Right. I think that, to your point, it's been a recalibration of where people are expecting rate cuts to go. And we were kind of in the bank of thinking that the long-term rates were going to settle around 4%, which it seems is pretty consensus at this point in time. That being said, to your point, that will be an elevated rate environment. And so borrowers are going to have to think about the type of debt that they're willing to take on. That being said, for credit markets, we think particularly private credit will benefit from a longer environment for higher rates. And so we're looking forward to being able to deploy that in the current environment.
You know, it's interesting, Sinjin, there seems to be kind of an acknowledgement that there is more and more bifurcation in certain parts of the economy. So what does this mean in terms of where you rather put your bets? Do you chase yield in the safer parts of the market, or do you start to dive into some distress?
I think it's a mix. And we at Beach Point, we deploy capital across the entire quality spectrum in trying to capitalize on that healthy mix of having both high carry, first lien, top of the cap structure, safer level of investments, combined with pretty significant deployment into different distressed opportunities. 2024 was a good example where distress on the high yield side was one of the biggest drivers of return. But it should also be pointed out that floating rate credit outperformed fixed income despite having 4 times the amount of default activity. And we would expect that that would continue into 2025. So deploying capital into more floating rate, given the higher for longer rate backdrop, seems to make sense at this point.
You know, it's interesting because when we're thinking about some of these distressed or even just deteriorating opportunities that are entering the market, that could be good for some investors who want to really capitalize on that. But are there types of deterioration that Apollo is completely looking away from right now, especially given you see some real weaknesses in places like consumer or auto?
I think it's a great question, and where we're spending a lot of our time. I think our expectation for 2025 is that there's going to be meaningful dispersion across the credit markets, and that will mean winners and losers. And so, to your point, there likely will be more stress and distress. We'll probably see more LME and distress type of activity. And for us, we in our credit business, as you know, spend a lot of our time on top of the capital structure, first lien, both in investment grade and non-investment grade type risk. And so we are really focused on continuing that trend versus focusing on second lien. And then secondly, when you think about our asset-backed business, to your point, it's a tale of 2 cities, right, in terms of consumers that are homeowners versus consumers that aren't. And so we are really making a lot of effort to focus on those that have higher quality backing behind them in terms of the types of asset-based opportunities that we are focusing on.
When you think about that push-pull between private markets and public markets, Sinjin, what do you think will be the most compromised in public markets? I can't tell actually sometimes which part we should be talking about where there's kind of more leverage, whether you think about public or private. Will we see more deal flow heading into one direction or another based on the dynamics that we're entering this year with?
Well, potentially. I think that there's convergence between these asset classes when there's higher rate vol. And issuers can step back and kind of choose what makes most sense to them to fill their financing needs. So a lot is going to depend on what rate vol does. It's also going to depend on what spreads do. We agree with the theme that there will be higher dispersion most likely, and that's really driven by, on the one hand, you have very solid credit fundamentals going into 2025, but on the other hand, you have very tight valuations. And so to the extent that any one of these asset classes sees more dispersion, that tends to instill a little bit of reticence upon issuers into going into that market for various reasons. And so that might be a bigger driver of which of these asset classes are most capitalized on by the issuer base itself.
It's interesting. If we sat here talking a year ago, I think what we would talk about, Akila, is, okay, leveraged loan markets. To what extent are they going to make private credit a little bit more difficult? But Apollo has really been pioneering a way to make public or private assets more like public assets, a little more liquid. How far does that theme go, especially because there are some naysayers out there about it?
Absolutely. I think, as Sinjin mentioned, we do believe that there is a convergence between public and private credit. And to your point, we've been talking about that for a long time. And we also think that there has been a theme of public markets being liquid and safe and private markets being illiquid and not safe. And so our view is that private can be just as safe, if not more safe, given the public markets are heavily concentrated and also not as liquid as they seem to be, particularly during periods of volatility. And our view is that private markets can provide some sort of liquidity, particularly when you're focusing on the higher end and higher quality end of the spectrum.
I want to also ask you a little bit about a popular trade from last year that I'm wondering how much it'll spill over to this year, especially with the expectations that lighter regulations might hit the banks. This synthetic risk transfer trade. There was a sense, I heard from Golden Tree's founder just a couple months ago, saying that those spreads would start to compress. Do you think that this will still be an attractive trade from here?
We do think it'll be an attractive trade, but it'll be about, like anything, picking your spots and making sure that you have, when we do participate in SRTs, as an example, we don't really like the blind pool risk. We want to understand everything that's going in the portfolio and understand the constituent pieces and the risk associated with it. So it may not be, it won't be one size fits all, but we do think there'll be interesting opportunities.
I do get interested about SRTs, Sinjin, to this degree. It is an amount of risk being offloaded from the banking system to the private capital world, to hedge funds, to private capital firms. Is there something inherently risky about these loans, or is this just another indication that the banking system will not be the end stop for this type of risk?
I think we fall into more of the latter camp, and this is just another iteration of that offloading of risk from bank balance sheets. We think that this is the sort of, again, the latest flavor of it, but certainly not the end of it.
I also, Sinjin, want to double down on something you were saying before. We were talking about the dispersion, right? We're seeing it in a lot of ways. Do you think, given where spreads have been of late, that investors are ignoring too many of the risks that are still underpinning this market?
Well, there's enough uncertainty on the horizon in terms of international geopolitics, domestic politics, and specific policy proposals that would likely induce more volatility and probably point to wider spreads just using sort of fair market value metrics. But at the same time, what I referenced earlier in terms of underlying credit fundamentals, which are still very sound. I mean, the leveraged credit borrower base has shown they have robust pricing power in an inflationary cycle. They've used the past several years to shore up their balance sheets, to improve their liquidity situations. Profit margins are at or near all-time highs, and leverage and other credit metrics are sort of down the fairway in terms of being more mid-cycle. And so as a result, the fundamentals sort of support tighter spreads. To the extent that we get some more exogenous impact to leverage credit from, a new tariff regime, for example, then yes, credit spreads will likely go wider. But again, I would re-emphasize the theme of dispersion, that it will likely be more sector-specific and more issuer-specific, which is what we've seen sort of in the latter half of the fourth quarter after the election.
No, it's interesting because one part of the market, we were talking about high yield a little bit earlier, but also leveraged loans have been expected to come back in a big way. Private credit is also waiting for that opportunity for M&A to come back. Akila, how big is that opportunity this year? How do you wrap your head around what's possible in terms of leveraged finance or private credit as in terms of M&A coming back?
It's a great point because with the upcoming administration, we do expect there to be a lot more flexibility as it relates to M&A, which should allow for more event-driven and event opportunities for us to participate both in the public and the private credit market. So we think it's going to be a higher dispersion environment, but also one that's event-rich. And so we're going to be pretty agnostic as it relates to private versus public, depending on what makes the most sense for the underlying issuer. But it should be a pretty big opportunity set for 25.
Certainly an alphabet soup of opportunities out there for credit markets this year. A lot to consider. Akila Grewal of Apollo and Sinjin Bowron of Beach Point. We thank you both for joining us, of course, on this first day back for real yields in 2025. Big year for bonds, but still ahead we have the final spread, which is the week ahead. The December jobs report on Friday. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. We have a lot coming up. Monday, Congress votes to certify the election results, plus U.S. durable goods and global PMI, some economic data coming out down the pike. Tuesday, U.S. dock worker labor talks resumes, plus Fed speak from Thomas Barkin. Wednesday, FOMC minutes, ADP payrolls data, and Samsung earnings. Thursday, the New York Stock Exchange and NASDAQ will be closed in honor of Jimmy Carter's state funeral, with the bond market closing at 2 p.m. And Friday, the December jobs report. For my final thought, we're going to look at those jobs numbers. Of course, a lot riding on what's happening in employment, and a lot of strength had been expected, but payrolls expected to be weaker, to come in at 153,000, the prior reading being 227,000, but the unemployment rate expected to stay flat. We're watching the rounding, though, because rounding up would be a bad thing, but perhaps things are stronger than you thought. From New York, that does it from us. Same time, same place next week. This was Real Yield.